This is ShadowQuant, Crypto Edition, brought to you by AresLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Monday, July 20, 2026, and this is the New York session. Now, let's get into it. Bitcoin is sitting at $65,094, holding the line with a modest 0.71% gain. But beneath that price lies a structural void. Futures demand has collapsed to 2024 lows. We are in an environment where the fear and greed index is stuck at 14 out of 100, labeled extreme fear. Yet institutional infrastructure is quietly building a new foundation. Let's look at what the data actually says right now. Turning our eyes to the schedule, the most significant catalyst landing on July 21, 2026, is the U.S. Senate proceeding with the housing bill that includes a CBDC ban. This legislative move directly impacts the policy narrative surrounding decentralized assets. Also on deck for July 21, 2026, is the release of detailed filing information for pays $1.10 billion NASDAQ IPO, which signals potential institutional entry points. Finally, we are monitoring updates from Monad regarding their BTC bridge, which may inject up to $5 billion in Bitcoin-backed liquidity into the ecosystem. Here is the snapshot as of 1903 ET. Total market cap stands at $2.30 trillion, with $72.20 billion in 24-hour volume. Bitcoin dominates at 56.57%, trading at $65,094, while Ethereum holds at $1,894.25, up 1.36%. The VIX is elevated at 18.77, reflecting persistent volatility in broader markets. We see a clear divergence. Retail sentiment is paralyzed by fear, while specific infrastructure layers like Uniswap at $3.60 and Chainlink at $8.53 are posting gains. Apex, walk us through the structural bifurcation we're seeing.
We are witnessing a split reality. On one side, you have the retail crowd trapped in extreme fear, evidenced by the 14/100 reading. On the other, you have capital rotating into utility-driven sectors. Look at Uniswap leading with plus 3.11% and ICP gaining plus 2.8%. Meanwhile, speculative laggards like Dogecoin are down minus 0.79%. This isn't random noise. It's a deliberate rotation away from meme volatility toward tangible infrastructure, fueled by headlines like TD Securities calling tokenization an institutional turning point. The market is effectively ignoring the fear gauge because the fundamental mechanics of capital allocation are shifting toward yield and utility.
That rotation brings us to the top news moving the needle today. First, Cointelegraph reports that Iranian crypto outflows spike 700% after U.S.-Israeli airstrikes. Second, CoinDesk notes that U.S. Senate housing bill includes CBDC ban, reinforcing the legislative tailwind for decentralized assets. And third, Cointelegraph highlights that Bitfinex revives tokenized bonds targeting crypto-native yield seekers, expanding the institutional yield canvas. SPECTER, let's start with the geopolitical risk there. The 700% spike in Iranian outflows sounds volatile. What does that do to the market structure?
It creates a hidden liquidity drain. That 700% spike in outflows following the airstrikes represents massive, untracked sell-side pressure entering the ecosystem. Standard volume metrics, like our current $72.20 billion, don't immediately capture this friction. When you combine that external shock with the fact that Bitcoin futures demand has hit 2024 lows, you have a perfect storm of evaporating internal support meeting surging external supply. This isn't just a trade. It's a stress test on the entire order book integrity. We are essentially watching a hollowed-out market try to absorb a geopolitical shockwave without the buffer of leveraged longs.
So we have external supply hitting a market with internal leverage dried up. Let's pivot to the domestic policy catalyst. The Senate housing bill includes a CBDC ban. How does that mechanically affect the current price action, particularly for XRP? It shifts the center of gravity. Right now, the Fear and Greed Index is at 14, which screams retail capitulation. But look at the 7-day trend. It's stabilized at 12. That flattening curve suggests the panic has plateaued. When you pair a stabilizing sentiment floor with a legislative ban on central bank digital currencies, you validate the thesis of decentralized alternatives. XRP is reacting to this by ticking up plus 1.1% to $1.11. It's not just noise. It's the market pricing in a future where non-CBDC assets are the default for settlement. The retail fear is still there, but the smart money is starting to align with the policy outcome.
Grid, let's get technical. Bitcoin is at $65,094, holding that psychological $65,000 level. You mentioned earlier that the collapse in futures demand makes this support fragile. What are you seeing on the chart?
I am seeing a structural decoupling. Price is holding at $65,094, but the engine underneath is gone. Futures demand is at 2024 lows, which means there is no speculative leverage cushioning any dips. The VIX is at 18.77, indicating that while equity volatility is elevated, crypto is currently drifting on thin order books. The technical structure is defensive. We are not seeing aggressive breakout patterns, we are seeing a hold status. If Bitcoin fails to hold $65,000 on this declining volume, the lack of buy-side liquidity depth means we could see rapid, unchecked selling pressure. There is no leveraged buyer to step in and catch the knife.
CIPHER, you argued earlier that flows are shifting to infrastructure. Does the $5 billion potential inflow from the Monad CB-BTC bridge change your view on Bitcoin's current $65,094 price level?
It changes the composition of the bid, not necessarily the immediate direction. Yes, the $5 billion from Monad's bridge provides a spot anchor. It offsets some of the leverage evaporation by bringing in real-world asset liquidity. However, look at the microstructure. Uniswap is up plus 3.11% and Chainlink is up plus 1.92%. The capital is flowing into decentralized finance and oracles, not just hoarding Bitcoin. The $5 billion inflow is a foundational layer. It prevents a catastrophic breakdown, but it doesn't guarantee an upward breakout right now. We are seeing a slow grind base building phase. Spot holders are absorbing supply, but without the fear of missing out driven leverage that usually pushes prices parabolic, the upward path is restricted.
Let's zoom in on Ethereum. It's trading at $1,894.25, up 1.36% and approaching the $1,900 resistance. Grid, what does the Ethereum chart tell us compared to Bitcoin?
Ethereum is showing relative strength, testing immediate resistance at $1,900. Its dominance is holding at 9.9%, which is notable given the broader market cap contraction. Unlike Bitcoin, which is defending a static level, Ethereum is attempting to push through a barrier. However, the volume profile suggests caution. Without a corresponding increase in overall market volume, this move feels constrained. The technical setup favors consolidation until either Ethereum clears $1,900 with conviction or Bitcoin drags it back down to test $1,844.86, the 24-hour low.
SPECTER, do you agree that Ethereum's strength is fragile given the broader risk environment?
I do. Ethereum's plus 1.36% gain looks attractive in isolation, but consider the core scientific disappointment. The mining sector turning lower after Q4 results is a leading indicator of operational stress. If the infrastructure providers supporting these networks are struggling with margins, Ethereum's utility case faces headwinds. Furthermore, the VIX at 18.77 tells me that risk-on assets like Ethereum are vulnerable to rapid reversals. Any upward move in Ethereum right now lacks conviction. It's a defensive rally, not an offensive breakout. Be wary of chasing that $1,900 level without confirmation from broader liquidity inflows.
Moving to Solana. Solana is at $77.40, up 1.73%. CIPHER,
Where are the flows going in the Layer 1 space right now?
Solana is benefiting from the general utility over speculation narrative, but it's not leading the pack. Look at NEAR, which is up plus 2.27%, and ICP at plus 2.8%. These high-performance L1s and data layer protocols are capturing the liquidity that used to go into generic meme chains. The flow data shows capital moving into protocols that offer tangible throughput and data availability. Solana is participating in the green wave, but the alpha is currently concentrated in the secondary tier of infrastructure plays like NEAR and ICP. The $77.40 price reflects steady accumulation, but the explosive growth is happening elsewhere in the stack.
Let's look at Uniswap. Uniswap is up plus 3.11% to $3.60. Pulse, why is the crowd warming to decentralized exchange infrastructure while Bitcoin fears are peaking? Because Uniswap offers actual yield and utility in a dead market. When the fear and greed index is at 14, retail traders stop gambling on meme coins. They start looking for places to park capital that generate returns. Uniswap's plus 3.11% gain is a signal that market participants are acknowledging the durability of decentralized exchange models. It's a hedge against the very extreme fear we're discussing. While Dogecoin drops minus 0.79%, Uniswap rises because it serves a function. The sentiment shift here is subtle but powerful. Investors are voting with their wallets for infrastructure resilience over speculative whimsy. Finally, let's touch on Chainlink. Chainlink is at $8.53, up 1.92%, supported by TD Securities' thesis on tokenization. Grid, does the chart support a continuation of this move?
Chainlink is respecting the uptrend, but we need to watch the $8.62 level, which was the 24-hour high. The current price of $8.53 is holding above the immediate support, but the volume hasn't surged to confirm a breakout. Technically, it's in a coiling phase. If it breaks $8.62 on increased volume, we see extension. If it rejects, we revert to the mean. For now, it's holding steady as a leader in the Oracle sector, mirroring the broader institutional interest in tokenized assets.
Apex tie this together. We have geopolitical shocks, a CBDC ban, futures demand at 2024 lows, and a rotation into utility. Where does the market stand?
The market is in a state of controlled defragmentation. SPECTER correctly identified the risk of the 700% Iranian outflows hitting a leveraged LAC market, and Grid accurately noted the fragility of the $65,000 support due to evaporating futures demand. However, CIPHER and Pulse highlight the counterforce. Capital is fleeing speculation for utility. The $5 billion from Monad and the PayPay IPO create a new bid side that doesn't rely on leverage. The result is a market that is statistically fearful but structurally adapting. We aren't seeing a crash. We are seeing a transition where spot liquidity replaces derivative speculation as the primary price driver.
To summarize today's analysis. First, Bitcoin is holding $65,094, but the collapse in futures demand to 2024 lows leaves this level technically fragile and vulnerable to thin book selling. Second, capital is rotating decisively from speculative memes like Dogecoin toward utility infrastructure, led by Uniswap's plus 3.11% gain and supported by the $5 billion Monad bridge inflow. Third, geopolitical risks, including the 700% spike in Iranian outflows, are adding external pressure to an internally hollowed-out market. Tomorrow, watch the U.S. Senate CBDC bill proceedings and the PayPay IPO filings for clues on whether institutional entry accelerates. This is ShadowQuant Crypto Edition. Stay informed. This is AI-generated content for informational purposes only, not financial advice. That wraps up this edition of ShadowQuant Crypto Edition. Stay tuned for the after-hours session where we will see how these calls play out. Until then, trade safe.